Almost everyone asks the same question when they begin building wealth. Should I start with stocks or real estate? It sounds like a practical question, but I usually answer it with another question. Why are you asking now? That second question reveals more than the first one. Most of the time, the person is not asking because they carefully studied both asset classes, compared liquidity, risk, leverage, tax treatment, learning curves, legal exposure, cash flow, time commitment, and capital requirements. They are asking because somebody close to them just made money in one of those areas. A friend bought a rental property, a cousin made money in the stock market, a coworker owns a few houses, a neighbor is talking about options. Someone online is showing rent checks, someone else is showing dividend income, and suddenly the person feels behind. This is how the mind works. There is a psychological pattern called the Baader-Meinhof phenomenon, also called frequency illusion. Once something becomes relevant to you, you begin seeing it everywhere. If you decide you may want to buy a Ford F-150, suddenly you see F-150s all over the road. They were always there. Your brain just did not care before. Once the thing becomes important to you, the mind starts filtering the world differently. Investing works the same way. If you buy shares of Coca-Cola, you suddenly care about Coca-Cola. You notice the product in stores, you notice earnings, you notice dividends, you notice the price to earnings ratio. You notice whether the dividend has been raised. You begin paying attention to details that would have meant nothing to you before. That is why I usually tell beginners to start with stocks. Not because real estate is bad. I like real estate. I think real estate can be one of the greatest wealth building tools in the tax code if it is handled properly. It gives you leverage, depreciation, cash flow, tax advantages, control, and long-term appreciation potential. But for a beginner, real estate can also punish you in ways a stock usually cannot. If you buy shares of Coca-Cola and the investment goes badly, the worst case outcome is that the share price falls, or in an extreme case, the investment goes to zero. That is painful, but the loss is generally limited to the money you put in. If you buy a rental property and make a bad decision, the downside can go beyond your initial equity. A tenant can stop paying. A tenant can damage the property, a roof can fail, an air conditioner can die in the middle of summer, a city can change rules, property taxes can rise, insurance can jump. A tenant can sue, mold can appear, a vacancy can last longer than you expected, a bad property manager can create problems, a repair can hit before you have reserves. A market you did not understand can turn against you. And while all this happens, the mortgage payment still comes due. That is the difference. Stocks are liquid and limited. Real estate is powerful but operational for a beginner. The first goal should not be to look sophisticated. The first goal should be to survive the learning curve. The best first asset is often the one that teaches you without destroying you. That is why stocks are a better starting point for many people. They give you skin in the game, and skin in the game changes your brain. You can watch 100 videos and still remain passive. You can read threads, listen to friends, watch experts, and collect opinions. But when you actually own one share of a company, the information becomes relevant. The earnings report matters, the dividend date matters, the valuation matters, the business model matters, the chart matters, the news matters. Ownership activates attention, and attention builds competence. I do not mean expertise. Expertise takes a long time. In many fields, people talk about 10,000 hours to mastery, but competence can come much faster with about 20 hours of focused skin. In the game effort, a person can become competent enough to stop guessing and start acting deliberately. That is the real value of beginning with stocks. The first goal is not to get rich immediately. The first goal is to become the kind of person who understands how money behaves. That is a much bigger goal. Most people try to make money before they become competent. That is backward. When you chase returns before you understand the machine, you are not investing. You are gambling with vocabulary. The correct order is competence. First, capital second, scale third. Stocks are a good training ground because the mistakes can be smaller, the liquidity is better, and the feedback is frequent. If you buy a stock today and need the money 3 months from now, you can usually sell it. You may sell at a loss, but you can get liquidity. The cash settles and you can move on. If you buy a rental property and need the money 3 months from now, the conversation becomes much harder. Selling real estate can take time. You may need repairs. You may need an agent. You may need to accept a discount. You may have closing costs. You may have a tenant in the property. You may be in a weak local market. You may not be able to sell without taking a serious loss. Liquidity is not a luxury for beginners. Liquidity is protection. It gives you flexibility. It gives you margin for error. And when you are new, margin for error is extremely important. Panic destroys wealth. Liquidity reduces panic. If one financial surprise can force you to sell at the wrong time or miss payments, then you are not investing from strength. You are investing from fragility. That is why I care so much about sequence. Where you end up is not the same as where you start. Long term, I like a balanced model. I like income, producing stocks. I like real estate. I like managed money or money where someone else is making the decisions or where the allocation is more passive. And I like cash or cash equivalents. A durable wealth system usually has multiple buckets, but in the beginning, the question is not only what assets are good, the question is what order protects the investor while the investor is still learning. The model I like is simple: 30% in income, producing stocks, 30% in real estate, 30% in managed money or professionally managed, passive, syndicated, or externally guided investments, 10% in cash or cash equivalents, which may include dry powder cash, gold, Bitcoin, or other liquid reserves depending on the investor. That 30-30-30-10 framework is not about being cute. It is about avoiding concentration. I have watched too many people build their entire financial life around one asset class, one market, one deal, one business, one employer, one property, or one strategy. Then the cycle turns and the person gets crushed. In 2008, housing was hit hard, stocks were hit hard, credit froze. People who were overconcentrated discovered that being right for a few years does not protect you from being fragile. The goal is not to chase what is hot now. The goal is to build wealth that lasts, and lasting wealth requires diversification across income streams, asset types, liquidity levels, and decision-making structures. But again, that is where you end up. Where you begin should often be with stocks. Not speculative stocks, not a tip from your brother-in-law, not some hot stock you heard about at the gym, not a company you bought only because someone online said it could go up 10 times. I am talking about quality, boring, income-producing companies, companies that have paid dividends for years, companies that have increased dividends over time, companies with real earnings, companies with stable revenue, companies with reasonable valuations, companies that let you learn while you own. Dividend stocks are a good classroom because they force you to think like an owner. When a company pays a dividend, it is returning part of its profit to shareholders. You begin asking whether the company can keep paying it. You ask whether revenue is stable. You ask whether earnings support the payout. You ask whether the dividend is growing. You ask whether the business can survive downturns. That is real investing. There are dividend aristocrats, companies that have increased their dividends for at least 25 consecutive years. Then there are dividend kings, companies that have increased dividends for at least 50 consecutive years. Names like Coca-Cola, Johnson & Johnson, and Procter & Gamble come to mind. These are not usually the most exciting companies. That is part of the point. A beginner does not need maximum excitement. A beginner needs a controlled learning environment. The boring company teaches discipline. It teaches valuation. It teaches cash flow. It teaches patience. It teaches that ownership is not the same as speculation. You can evaluate these companies through a simple filter. Does the stock yield more than 2% in dividends? If I pay $100 for the stock, is it paying at least $2 per year? And more importantly, is that dividend likely to grow? If the dividend grows over 10 or 20 years, the income on your original cost can become very meaningful. What begins as $2 can become $5, $8, or $10 over time. If the company keeps raising the payout, has the stock been trending upward or at least moving in a stable channel? I do not want a beginner trying to catch a falling knife. If a stock is collapsing, there may be a reason. The beginner may not know what that reason is. A stable, established company gives you a better classroom. Does the stock have options? If it does, you may later learn to sell covered calls or cash secured puts. That is not where every beginner starts, but it can become part of an income strategy. The idea is to create multiple streams of income from one asset, getting paid to enter, getting paid dividends while holding, getting paid to sell calls, and getting paid if shares are eventually called away at a higher price. Has the dividend been consistent for at least 10 years? Consistency matters. A company that pays and increases its dividend across cycles is telling you something about durability. Is the revenue stable or growing? A dividend without a supporting business is dangerous. You want a company that continues producing enough revenue and earnings to fund the payout. Is the price-to-earnings ratio reasonable? If you are buying a mature dividend company at an absurd valuation, you may be overpaying. A reasonable range depends on the industry and company, but beginners should learn to ask whether the price makes sense relative to earnings. Are analysts broadly positive? Analysts are not always right. I do not blindly follow them. But if the entire analyst community is negative and the beginner does not know why, that is a warning. If there are more buy ratings than sell ratings, it may at least confirm that you are not alone in seeing value. The point of the filter is not perfection. The point is process. You are learning to ask questions before buying. That is what investing requires. Most people buy first and ask questions later. That is backward. When you use a filter, you slow yourself down. You replace excitement with criteria. You create a discipline that protects you from your own impulses. That is why stocks are useful early. You can buy a small amount, learn, observe, and improve. If you make a mistake, it may hurt, but it probably does not ruin your financial life. Real estate is different. Real estate is not harder because houses are complicated to understand. A house is easy to see. You can touch it, you can walk through it, you can understand bedrooms, bathrooms, kitchens, neighborhoods, and rent. That is why beginners think real estate is easy, but understanding a house is not the same as understanding real estate investing. Real estate investing means markets, financing, reserves, capital expenditures, tenants, maintenance, property management, insurance, vacancy, legal structure, asset protection, LLCs, land trusts, cash flow, debt service, taxes, depreciation, local rules, eviction laws, contractors, inspections, appraisals, property taxes. A house is simple. A real estate investment is a system. If one part of the system breaks, the cost can be large. This is why beginners get hurt. They watch a few videos, they save $20,000 or $30,000, they buy a cheap rental in a market they do not understand. Then the tenant stops paying, the AC dies, the roof leaks, the property taxes rise, insurance changes, the cash reserves are gone. Suddenly, the investment that was supposed to create freedom creates pressure. The problem is not that real estate is bad. The problem is bad sequencing. If your first property can wipe out your entire cushion, you are not investing, you are overexposed. Real estate becomes powerful when the risk is mitigated if you have reserves, good underwriting, a proper structure, a strong property manager, correct insurance, and a realistic vacancy assumption. Real estate can be phenomenal. The tax code often rewards real estate owners. Depreciation can shelter income, bonus depreciation may help under certain circumstances, leverage can magnify returns. A 1031 exchange can defer taxes, step up in basis can be powerful for heirs. The tax code loves real estate, but the tax code does not protect a beginner from a broken roof when the beginner has no cash. That is why I am not anti-real estate, I am anti-blowing yourself up with real estate before you are ready. If you are new and you want real estate exposure, there are smarter first steps. The first is house hacking. You buy a primary residence with extra rooms or a duplex, triplex, or small multifamily property. You live in one part and rent out the other parts. Maybe you rent bedrooms. Maybe you rent a basement. Maybe you own a duplex and live in one unit while the other unit helps cover the mortgage. This gives you training wheels. You are still learning to be a landlord, but the asset is also your home. You are using financing available for owner-occupied property. You are building equity. You are learning about tenants, repairs, rent, and management. But you are not starting with a distant rental in a market you do not understand. House hacking can be powerful because it turns a personal housing cost into a wealth-building tool. If another person's rent helps pay your mortgage, your housing burden falls. If you do it repeatedly, you can build meaningful equity over time. It still has risk. Roommates can be difficult, tenants can fail to pay, local rules matter, but it is often a more controlled way to begin. The second strategy is live. In improvement, you buy a primary residence that needs work. Maybe it is outdated, maybe it is ugly, maybe it needs cosmetic repair. You live in it, improve it, and after at least 2 years, you may sell it and potentially exclude a large amount of gain from federal tax if you meet the rules. In the United States, under current general rules, if you are single, you may exclude up to $250,000 of gain from federal tax on the sale of a primary residence. If you meet the ownership and use requirements if married filing jointly, the exclusion may be up to $500,000. The basic idea is that you must have lived in the property as your primary residence for 2 of the last 5 years. That is a huge wealth-building tool. You needed a place to live anyway. If you choose a property that can be improved, and you live there while making improvements, you may build equity in a tax-advantaged way. You are not renting to someone else. You are not managing a traditional rental. You are using your own housing as part of your wealth strategy. Many people have built capital this way. They buy a property, fix it up, live in it, sell after qualifying, repeat. Over a decade that can create meaningful wealth without immediately jumping into landlord risk. The third early real estate exposure is REITs, real estate investment trusts. REITs let you own real estate with the liquidity of a stock. Publicly traded REITs own portfolios of properties. They may own apartments, shopping centers, industrial warehouses, healthcare buildings, data centers, storage units, cell towers, offices, or other types of real estate. They trade on public exchanges and usually pay dividends. This is a useful bridge. You learn how real estate behaves. You see occupancy, you see funds from operations, you see debt levels, you see interest rate sensitivity, you see rent growth, you see property types. But you are not trapped in one house with one tenant and one roof. That is why REITs can be a great training ground for beginners who want real estate exposure without immediately taking operational risk. Again, REITs can fall. They are not risk-free. They are affected by interest rates, property markets, management decisions, debt, and sector risk. But they are liquid, diversified, and educational. That makes them useful. Now, one of the biggest dangers today is bad information. This is true in taxes. It is true in real estate. It is true in stocks. It is true with AI-generated answers. A novelist named Michael Crichton describes something often called the gel, man amnesia effect. The idea is that when you read an article about a subject you know deeply, you often notice errors, oversimplifications, and wrong assumptions. Then you turn the page and read an article about a subject you do not know, and you forget that the same problems may be present there too. That is dangerous. If you are an expert in taxes and read a tax article, you may immediately see that it is incomplete or wrong. But if you read a real estate article and you are not an expert, you may assume it is accurate. The same happens with AI. If you ask AI about a field you understand, you can see when it hallucinates. If you ask it about a field you do not understand, you may not know what is wrong. This is why systems matter. Do not rely on simplified information from people who may not actually be doing the thing. Do not let a short video convince you to put your entire cushion into a property. Do not let someone as highlight reel become your investment plan. Look at the numbers. Follow a system. If you cannot explain the numbers, you should not do the deal. In stocks, that means understanding revenue, earnings, dividends, valuation, payout ratios, debt, business quality, and risk. In real estate, that means underwriting conservatively. If a property rents for $1,500 per month, do not pretend you keep $1,500. You do not taxes, insurance, maintenance, management, vacancy, repairs, and capital expenditures all take their share. A common rough conservative assumption is that around half of gross rent may disappear into operating expenses before debt service. That does not apply perfectly to every property, but it is a useful warning against fantasy underwriting. If rent is $1,500, maybe $750 is left before the mortgage. That $750 still has to cover the debt service. If the mortgage payment is higher than what remains after realistic expenses, the deal may not cash flow. If the math does not work, do not do the deal. Period. This is the discipline real estate requires. People get excited by gross rent. Professionals care about net operating income and cash flow after debt service. That difference can decide whether a property builds wealth or creates stress. Now let us come back to sequence. If I were guiding a beginner, I would start with stocks because stocks teach competence and preserve liquidity. I would start with quality dividend, paying companies, and broad learning. The purpose is not to gamble. The purpose is to learn how money behaves, how ownership works, how cash flow works, how valuations move, and how businesses report results. Then, as capital grows, I would move into real estate in a smart way, house hacking if it fits your life, live in improvement if you are willing to do the work. REITs if you want exposure without operational risk. Then later, when you have more reserves and competence, direct rental real estate can make sense. By then, one bad tenant or roof replacement does not destroy your life. It becomes part of the model. That is a very important transition. A repair should not be a crisis. A vacancy should not be a crisis. A bad tenant should not be a crisis. If ordinary real estate problems become financial emergencies, you are not ready for that level of exposure. The same principle applies to stocks. A 20% drawdown should not make you sell everything in panic. If it does, the allocation is too large or the investor does not understand the asset. An investment should fit your capacity to withstand its normal problems. Every asset has normal problems. Stocks fall, real estate needs repairs, tenants disappoint, dividends can be cut, REITs can decline, managed money can underperform, cash can lose purchasing power, gold can go nowhere. Bitcoin can be extremely volatile. There is no perfect asset. There is only a structure that allows you to survive the weaknesses of each asset while benefiting from their strengths. That is what the 30-30-30-10 model is trying to do. 30% income producing stocks. This bucket gives liquidity, dividends, public market exposure, and the chance to learn business analysis. It may include dividend stocks, income strategies, municipal bonds for certain tax brackets, or other income producing securities depending on the person. The key is that this is a liquid income bucket. 30% real estate. This can include direct rentals, REITs, real estate syndications, multifamily, single-family rentals, house hacking, or other real estate exposure. The key is productive property exposure and the tax benefits that can come with real estate. 30% managed money. This is money where you are decoupling some decisions from your own emotions. It may be ETFs, professionally managed portfolios, syndications, or other structures where you are not actively making every decision. The point is to avoid being your own only decision maker in every part of the portfolio. 10% cash or cash equivalents. This is dry powder. It is liquidity. It is the bucket that lets you handle emergencies and take advantage of opportunities. It may include cash, short-term instruments, gold, Bitcoin, or other assets depending on how you define cash equivalents and your risk tolerance. But the core idea is liquidity and flexibility. The cash bucket is not something you fill last. You build it as you go. If you have $50,000 in stocks, you should also have a meaningful cash buffer. If you are building toward a larger portfolio, the 10% reserve keeps you from becoming forced to sell. Cash may not produce the highest return, but cash creates options. Options have value. This is another principle beginners often miss. They want every dollar working aggressively. That sounds efficient, but it can make them fragile. A person with no cash reserve is vulnerable to life. One emergency can force bad selling, bad borrowing, or bad decisions. A person with dry powder can act when others are forced to react. That is how wealth transfers during downturns. The prepared buy from the panicked. The panicked are usually panicked because they did not keep enough liquidity. Now, let us talk about managed money. Some do. Yourself investors resist managed money because they want control. Control can be good if you are competent and disciplined. But many investors become overconfident and overconcentrated. They put too much into one idea. They trade too much, they panic, they chase, they do not realize that part of diversification is diversifying decision. Making managed money can mean hiring an advisor if your portfolio is large enough and the advisor is good. It can also mean using ETFs, index funds, target allocations, robo-advisors, or professionally managed vehicles. It can mean syndications where the operator manages the asset. It can mean mirroring an established strategy. The point is not to give up all control. The point is to reduce the chance that one emotional brain makes every decision under stress. That is a risk control. Most people underestimate behavior risk. They worry about market risk. They worry about tenant risk. They worry about interest rate risk. But the biggest risk may be themselves. Managed structures can help reduce that if chosen carefully. Now let us think about a $1 million portfolio under the model, about $300,000 in income, producing stocks or similar liquid income assets, about $300,000 in real estate or real estate equivalents, about $300,000 in managed money, about $100,000 in cash or cash equivalents. This is not a law, it is a model. A person's age, tax bracket, income, risk tolerance, goals, state, family debt, and knowledge all matter. But the model gives a framework to avoid being all in on one thing. It also creates multiple forms of learning. Stocks teach business ownership and public market behavior. Real estate teaches cash flow, leverage, taxes, operations, and tangible asset management. Managed money teaches discipline and humility. Cash teaches patience and optionality. Together, they form a durable system. Now, one thing I have learned is that people often want to skip chapters. Someone is in chapter 1 financially, but they are copying someone else's chapter 20. They see a real estate investor with 10 properties and want to buy a rental immediately. They see an options trader generating income and want to sell options aggressively. They see someone using leverage and assume leverage is the secret. They see a syndication investor and want to put money into private deals before understanding the risks. That is dangerous. What works for someone with experience, reserves, legal structure, cash flow, and a large balance sheet may not work for someone just beginning. A strategy can be good and still wrong for your current stage. That is why sequence matters so much. You do not need to avoid advanced strategies forever. You need to earn the right to use them. Earn it through competence, capital reserves, and experience. Now, let us talk about options briefly because they were mentioned as part of stock income strategies. A cash-secured put can pay you for agreeing to buy a stock at a certain price. A covered call can pay you for giving someone else the right to buy your stock at a higher price. These can be useful tools when used properly with quality companies, appropriate sizing, and understanding of obligations. But options can also destroy beginners when used recklessly. If you do not understand the obligation, do not use the tool. A covered call on a stock you own is very different from buying short-term out of the money options with money you cannot afford to lose. A cash-secured put is very different from naked leverage. Income strategies can be conservative or reckless depending on structure. The principle is the same: learn first, scale later. Do not risk large capital on a tool you do not understand. Now let us talk about why the first 20 hours matter when you first buy a stock. You may not understand PE ratios, dividend yield, payout ratios, or revenue trends. But once you own it, you care. You begin learning. Every term becomes relevant. That relevance accelerates learning. The same thing happens in real estate, but the cost of learning can be higher if you begin with direct ownership before reserves. A stock mistake may be a tuition payment. A property mistake can be a graduate degree priced at the worst possible moment. This is why I prefer stocks as the first classroom. It is not because stocks are better than real estate forever. It is because they are often better for the first stage of competence. Eventually, real estate can become one of the most powerful tools in the whole system. The tax code favors it. Depreciation can shelter income, leverage can amplify returns, tenants can pay down debt, appreciation can build equity, a 1031 exchange can defer taxes. Step up in basis can be powerful for heirs. Real estate can create generational wealth, but only if it is done with proper reserves, underwriting, and structure. Otherwise, the same leverage that builds wealth can destroy liquidity. Leverage is a force multiplier. It multiplies wisdom or mistakes. A mortgage lets you control a large asset with a smaller amount of capital. That can be wonderful if the property cash flows and appreciates. It can be painful if the property goes vacant, needs repairs, and the market turns down. Stocks, especially fully paid shares, usually do not demand monthly payments from you. A rental property with debt does. That difference matters for beginners. Now, let us discuss the emotional side. When people ask whether to start with stocks or real estate, they often are not asking calmly. They are feeling pressure. They feel like others are getting ahead. They feel like they are missing out. They see other people's success and want to move. This is why the first question matters. Why are you asking now? If the answer is because I have a plan, capital reserves, and a desire to build competence, that is good. If the answer is because I just saw someone else making money, slow down. Other people's success does not mean the opportunity is right for you today. The frequency illusion can make something look suddenly obvious, but that does not mean it is the right step. Your brain may be noticing the asset class because it has become emotionally relevant, not because the math is good. Do not let a psychological trigger become your investment strategy. Instead, use the trigger constructively. If real estate suddenly interests you, study it. If stocks suddenly interest you, buy a small quality position and learn. If dividends suddenly matter to you, understand payout ratios and dividend growth. If house hacking interests you, study local rules, financing, tenant laws, and cash flow. The interest can be valuable if it becomes education. It is dangerous if it becomes impulsive action. Now, what does good real estate underwriting look like? It begins with gross rent, but it does not end there. You subtract vacancy, you subtract property taxes, you subtract insurance, you subtract maintenance, you subtract management fees, even if you self-manage, because your time has value and someday you may need management. You subtract capital expenditures, roofs, HVAC appliances, flooring, plumbing, electrical systems, and exterior repairs, all age. Then you see what is left before debt, then you subtract the mortgage payment. If the result is negative or too thin, you have to ask why you are doing the deal. Appreciation may happen, but appreciation is not guaranteed. Tax benefits may help, but tax benefits do not pay the plumber if you have no cash. A deal that depends entirely on appreciation and ignores cash flow can become speculative. Some investors use appreciation strategies successfully, but beginners should not confuse speculation with investing. Cash flow creates durability. Durability gives you the ability to hold through cycles. Holding through cycles is where real estate wealth is often made. Again, liquidity and reserves matter. Now let us talk about the stock side in more detail. A dividend stock is not good merely because it pays a dividend. Some companies pay dividends they cannot afford. Some have high yields because the stock price has collapsed and the market expects a cut. A high dividend yield can be a warning, not an opportunity. That is why the filter matters. You want not only yield but quality. Stable or growing revenue, reasonable payout ratio, long dividend history, dividend growth, manageable debt, reasonable valuation, options availability if you want income strategies, positive analyst coverage, trend stability. This does not guarantee success, but it improves the odds. A beginner should focus on companies that can survive. Survival is underrated. You do not need every stock to double quickly. You need to build understanding, collect income, avoid catastrophic mistakes, and stay in the game. This is how competence compounds. Now let us address the person who says real estate builds wealth faster because of leverage. Sometimes that is true. Leverage can accelerate wealth. A 20% down payment controlling a property that appreciates can create strong returns on equity. Tenants paying the mortgage can build equity tax. Benefits can improve after-tax results. But leverage also accelerates pain. A property that needs repairs goes vacant or falls in value still has debt attached. If the mortgage payment is due and rent is not coming in, you need cash. If property values fall and you need to sell, you may be trapped. If insurance rises and rents cannot keep up, cash flow shrinks. If interest rates rise on adjustable debt, the model changes. So the question is not whether real estate can build wealth faster. It can. The question is whether the beginner can survive the downside of leverage before reaching the upside. Many cannot. That is why stocks may be the better first step, not forever first. Now let us address the person who says stocks are too volatile. Yes, stocks are volatile. But volatility is not the same as operational liability. If a stock falls 30%, you may be uncomfortable, but you are not forced to replace a roof. You are not dealing with an eviction. You are not paying a mortgage on a vacant unit. You are not being sued by a tenant. Public market volatility is visible. Real estate risk is often hidden until it appears as a cash expense. Beginners sometimes prefer real estate because the price does not update every second. That can feel safer. But the asset may still be risky. You just do not see the market price every day. Illiquidity can feel like stability. It is not always stability. Sometimes it is simply delayed feedback. A good investor understands both kinds of risk. Stocks give immediate price feedback and high liquidity. Real estate gives slower feedback, less liquidity, and operational risk. Both can build wealth. They require different temperaments. Now let us talk about taxes. Real estate has extraordinary tax advantages. Depreciation can shelter rental income, bonus depreciation, cost segregation, 1031 exchanges, and step-up. In basis can create powerful outcomes. If structured properly, a family may defer or even eliminate tax on appreciation over long periods. That is real. But tax benefits should not rescue a bad deal. A bad deal with good tax treatment is still a bad deal. The economics must work before the tax strategy. I have seen people buy real estate because they love the tax benefits. But the cash flow is weak, the market is poor, the property is difficult, and reserves are insufficient. That is not tax planning. That is using the tax code to justify a bad investment. Start with the asset. Then optimize taxes, not the other way around. Now let us talk about asset protection. Real estate often requires more legal structure than stocks. If you own rental property, you need to think about liability, LLCs, insurance, land trusts, property management, leases, compliance, and tenant law can matter. A tenant injury or legal dispute can create exposure. Stocks do not usually require the same operational asset protection for a beginner. You still need overall financial planning, beneficiary designations, estate planning, and account structure. But owning shares of a public company is not the same as directly owning property where people live. This is another reason beginners should start simpler. Simplicity reduces the number of ways you can be wrong. As you grow, complexity can be added, but complexity should be earned. Now let us talk about the cash bucket. Many investors hate cash during bull markets because cash looks lazy. Stocks rise and cash earns less. Real estate appreciates and cash sits still. Crypto runs and cash feels foolish. But when the downturn comes, cash becomes power. Cash lets you buy stocks at lower prices. Cash lets you repair properties without panic. Cash lets you cover vacancies. Cash lets you survive job loss. Cash lets you avoid high-interest debt. Cash lets you say no to bad financing. Cash gives you time. Time is often the most valuable thing in a crisis. A person with cash can wait. A person without cash must react. So the 10% cash bucket is not dead money. It is optionality. It is margin for error. It is the thing that protects the rest of the portfolio from forced liquidation. That is why the cash bucket must be filled as you go, not after everything else. Now let us talk about why chasing hot strategies is dangerous. People see someone succeeding in options, crypto, short-term trading, wholesaling real estate, Airbnb arbitrage, flipping houses, or buying distressed rentals. They copy the result without understanding the process. They do not see the failures, reserves, experience, legal structure, timing, or risk behind the success. They copy chapter 20 while they are on chapter 1. That is how people blow up. A strategy that works for an expert can destroy a beginner. This is not because the expert is lying, although sometimes they are. It is because the strategy depends on knowledge the beginner does not yet have. You cannot skip competence. You can only hide the lack of competence until the market exposes it. That is why the first objective must be learning with controlled downside. Stocks give you that better than direct real estate in many cases. Now, let us build a clear sequence. Step 1. Build a cash buffer. Before aggressive investing, you need reserves. Emergency cash protects you from life. It also protects your investments from forced selling. Step 2. Begin with quality income. Producing stocks or broad diversified stock exposure, use small positions, learn dividends, earnings, valuation, and business analysis. Build pattern recognition, understand how markets move. Learn what it feels like to own assets. Step 3, add real estate exposure intelligently. Start with REITs. House hacking or live in improvements if those fit your situation. Do not rush into a distant rental with your entire cushion. Step 4, gradually move toward direct real estate only when reserves, knowledge, and structure are ready. Underwrite conservatively, assume repairs, assume vacancies, use proper insurance and legal structure. Do not depend on best-case assumptions. Step 5, add managed money or passive systems to reduce decision making risk. ETFs, advisors, syndications, or managed strategies can help diversify both assets and decision making. Step 6, maintain cash or cash equivalents. Never let the portfolio become so fully invested that one shock forces bad decisions. Step 7, rebalance toward a durable 30-30-30-10 structure. As wealth grows, that is a rational order, not exciting. Rational excitement is not the goal. Financial durability is. Now, what does this mean for a young person? If you are young and just beginning, buy a small basket of quality dividend stocks or a broad market fund. Learn, watch earnings, study dividends, understand valuation. Build a habit of investing, keep some cash, avoid debt traps. Do not rush into a rental property because someone on the internet made it sound passive. Real estate is not passive when you are undercapitalized. It is only passive after systems, reserves, and management are in place. Before that, it is active responsibility. If you want real estate, consider house hacking or improving your primary residence. Those strategies can be more forgiving because they combine housing need with investment learning. Now, what does this mean for someone with more capital? If you already have meaningful savings, a stable income, and some investment knowledge, real estate may be appropriate sooner. But the same principles apply. Underwrite conservatively, keep reserves. Protect assets legally, do not overleverage, do not buy only because of tax benefits, use proper management. Your size changes the opportunity set, it does not eliminate risk. Now, what does this mean for someone who loves real estate and hates stocks? I would still suggest learning stocks because public markets teach you a lot about businesses, interest rates, valuation, cash flow, and investor psychology. You do not need to make stocks your only focus. But avoiding public markets completely can leave you with a narrow financial education. The reverse is also true. A stock investor should learn real estate because real estate teaches leverage, taxes, cash flow, tangible assets, debt service, and local market behavior. Both asset classes sharpen the investor. The strongest investors often understand multiple assets. They do not worship one. Now, what does this mean for someone who loves stocks and hates real estate? You can build wealth with stocks alone. Many people have a simple portfolio of broad index funds, dividend stocks, and disciplined contributions can build substantial wealth. You do not have to become a landlord, but you should understand real estate enough to make intelligent housing decisions, evaluate REITs, and avoid misinformation. Again, competence matters. Now let us return to the original question, stocks or real estate. The answer is not that one is permanently superior. The answer is sequence and suitability. Stocks often come first because they are liquid, teach competence, allow smaller mistakes, and create ownership awareness. Real estate often comes later because it is powerful but requires reserves, underwriting, legal structure, management, and the ability to survive operational problems. Eventually, a balanced wealth system may include both. The mistake is choosing based on what someone else is making money in right now. The mistake is letting frequency illusion or social pressure dictate your asset allocation. The mistake is going all in on a strategy you do not yet understand. The mistake is confusing visibility with safety. The mistake is ignoring liquidity. The mistake is underwriting real estate using gross rent instead of realistic cash flow. The mistake is buying stocks without a filter. The mistake is having no cash bucket. The mistake is copying someone else's advanced strategy while you are still a beginner. Those mistakes are avoidable. And avoiding big mistakes is one of the most important parts of wealth building. You do not need to be brilliant if you stop doing things that can take you out of the game. That is one of my core principles. Survival first, competence second, scale third. Now, let us discuss lasting wealth. Lasting wealth is not built by one move. It is built by a system that can handle different environments. Stocks may perform well in one period. Real estate may perform well in another. Cash may feel useless until it saves you. Managed money may underperform 1 year and reduce behavioral mistakes over a decade. A durable system gives you multiple ways to win. Income from dividends, income from rents, income from covered calls or other conservative option strategies if you understand them. Growth from equity appreciation, tax advantages from real estate, liquidity from public markets, dry powder from cash, professional or passive management from managed money. This is how the buckets work together. Each bucket has a job. The problem with beginners is they often put every dollar into one job. All cash, all stocks, all real estate, all crypto, all options, all one business. That is fragile. A durable investor builds multiple engines. Now, let us talk about cash flow because it sits underneath everything. Cash flow is what gives you independence. A stock that pays dividends creates cash flow. A rental property with positive cash flow creates cash flow. A bond or muni can create cash flow. Covered calls can create cash flow if used properly. Managed income strategies can create cash flow. Cash flow gives you choices. It reduces the need to sell assets. It lets you reinvest. It lets you live with less dependence on labor income. But cash flow must be real. Do not mistake gross rent for cash flow. Do not mistake a high dividend yield for safe cash flow. Do not mistake option premium for free money. Do not mistake appreciation for cash flow. Real cash flow remains after realistic expenses, reserves, and risk. That is the kind of cash flow that builds wealth. Now, let us talk about appreciation. Appreciation is wonderful, but it is not fully controllable. A property can appreciate because of market growth, inflation, improvements, location, and scarcity. A stock can appreciate because earnings grow, valuations rise, or sentiment improves. But appreciation is partly market-driven. Cash flow gives you durability while waiting for appreciation. That is why I like assets that pay you while you own them. Buy chickens and eat the eggs. Do not eat the chickens. This is a simple metaphor, but it captures the idea you want assets that continue producing. If you consume the asset itself, the asset disappears. If you own productive assets and use the income, the wealth machine remains. Stocks with dividends can be chickens. Rental properties with cash flow can be chickens. Businesses can be chickens. The goal is to build a farm of productive assets, not to keep selling the animals every time you need food. Now, how do you become the kind of person who builds that farm? You begin with manageable ownership. You buy quality assets. You pay attention. You learn the terms. You understand the reports. You make small mistakes. You improve. You add another asset. You diversify. You build reserves. You learn taxes. You learn legal structure. You learn cycles. You become less emotional. That is wealth education. It is not one video. It is not one book. It is ownership plus attention over time. Now let us talk about risk again, because risk is not only losing money. Risk is also losing confidence. A beginner who gets destroyed on the first real estate deal may avoid investing for years. A beginner who loses money in options may conclude the whole market is a casino. A beginner who buys a bad stock tip may stop trusting equities. That is why first experiences matter. You want the first experiences to teach, not traumatize. Stocks, chosen conservatively, can teach with limited downside. A bad rental can traumatize because the mistake follows you every month. This is why starting safer is not cowardice. It is intelligent sequencing. Now let us close with the practical answer. If you are just beginning, start with stocks, start with quality, start with liquidity. Start with income, producing companies, or broad market funds. Use your ownership to train your attention. Learn dividends, learn earnings, learn valuation, learn risk, build confidence, keep cash, then move toward real estate carefully. Use house hacking if it fits. Use live in improvements if it fits. Use REITs as a training bridge. Do not put your entire cushion into a direct rental before you understand reserves, tenants, repairs, insurance, legal structure, and cash flow. As your capital grows, move toward a diversified wealth system. 30% income, producing stocks, 30% real estate, 30% managed money, 10% cash or cash equivalents. Adjust for your life, but respect the principle. Do not overconcentrate, do not chase, do not copy someone else's later chapter. Do not confuse a hot story with a good sequence. Stocks and real estate can both build wealth. The question is which one should teach you first, and which one you are ready to handle today. For most beginners, stocks are the better first teacher. Real estate can be the better later accelerator. And lasting wealth is built when you learn the difference.